Welcome back to the channel. Today we're tackling one of the most critical aspects of buying a home, understanding your mortgage and financing options. For many first-time buyers and even experienced homeowners, figuring out how much house you can afford, choosing the right loan product, and securing a great interest rate are some of the biggest hurdles in the home buying process. In this guide, we'll address some of the most common queries people search for online, like how much house can I afford? And where can I find the best mortgage rates in 2025? As well as explain the differences between FHA and conventional loans, first-time home buyer programs, and how to use mortgage calculators to your advantage. By the end of this video, you'll have a clear understanding of how financing works and be better equipped to make informed decisions. How much house can I afford? One of the very first questions that comes to mind when you're considering buying a home is, how much house can I afford? This is a crucial starting point because it sets the parameters for your entire home search. Overextending yourself financially can lead to stress and even potential foreclosure down the line, while staying within a comfortable range ensures you maintain a healthy balance between home ownership and other financial goals. To determine how much house you can afford, start by looking at your monthly budget. Consider your income sources, existing debt, and savings. Mortgage lenders typically use a guideline called the debt-to-income ratio, DTI. Your DTI compares your monthly debt payments to your gross monthly income, and most lenders prefer this ratio to be at or below 43%, though some programs allow for higher DTIs. A simple way to approach this is to add up all your monthly debts, such as car loans, student loans, credit card payments, and then add in what you estimate your new mortgage payment will be, including principal, interest, taxes, and insurance. Divide that total by your monthly gross income. If the percentage is too high, you may need to either lower your target home price or pay down existing debts to improve your ratio. Using a mortgage calculator. A mortgage calculator is a powerful tool that can quickly give you insight into monthly payments and loan amounts, and how different variables like interest rate and down payment affect what you'll pay. When you go online and search for a mortgage calculator, you'll find user-friendly interfaces where you can input details like the home's purchase price, your anticipated down payment, the expected interest rate, and the loan term, typically 15 or 30 years. The calculator will then show you an estimated monthly payment. Experiment with different numbers. For instance, try increasing your down payment from 5% to 10% and see how it changes your monthly bill. Try adjusting the interest rate or the length of the loan. This exercise helps you understand how sensitive your mortgage payment is to these variables and can guide you in making decisions, like whether to save for a bigger down payment or shop around for a lower interest rate. Finding the best mortgage rates in 2025. The search term, Best Mortgage Rates in 2025, highlights how important it is for buyers to stay updated on market trends. Mortgage rates fluctuate daily and are influenced by a variety of factors, including the Federal Reserve's monetary policy, inflation, and the overall health of the economy. Even a small difference in interest rate, say 3.5 versus 4%, can translate to thousands of dollars saved or spent over the life of your loan. How do you find the best mortgage rates? Start by researching online. Many financial news outlets, mortgage brokers, and lending marketplaces regularly publish average rates. Then get quotes from multiple lenders, banks, credit unions, mortgage brokers, and online lenders. Don't be shy about comparing at least 3 to 5 offers. Each lender may have unique loan programs, closing cost structures, or rate lock options. Remember that the lowest advertised rate might come with additional fees or require points and upfront costs to lower your rate. So be sure to compare the annual percentage rate, APR, for a more accurate cost assessment. Keep your credit score in good shape, as this is a major factor in determining what rate you'll qualify for. Generally, higher credit scores receive lower interest rates. If your score needs work, take a few months to pay down debts, correct any errors on your credit report, and avoid opening new lines of credit. The effort can pay off significantly with better financing terms. If you're a first-time homebuyer, it's natural to search for first-time homebuyer loans to see what special programs might be available to you. These programs are designed to make it easier for people new to homeownership to get into the market, often with lower down payments, relaxed credit requirements, or reduced closing costs. Many states and cities have their own first-time buyer incentives, such as down payment assistance or grants that help cover a portion of the initial costs. At the federal level, programs insured by the Federal Housing Administration, FHA, or those offered through the U.S. Department of Agriculture, USDA, or the Department of Veteran Affairs, VA, can be highly beneficial. For instance, FHA loans allow buyers to put down as little as 3.5%, making them very popular with first-timers who haven't had the chance to save a substantial down payment. VA loans available to eligible veterans and active duty service members can come with zero down payment requirements and very competitive interest rates. USDA loans are an option for those looking in rural areas and often have no down payment requirement as well. When researching these programs, pay attention to eligibility criteria. Some focus on income limits, property location, or require completion of a home buyer education course. While it might seem like extra steps, these education courses can provide valuable knowledge to help you navigate the home buying journey confidently. FHA versus conventional loans, understanding the differences. One common comparison shoppers make is FHA versus conventional loans. While both are popular, they cater to slightly different borrower profiles and have distinct requirements. FHA loans, insured by the Federal Housing Administration, FHA loans are known for their lower credit score requirements and lower down payment options. They're popular among first-time homebuyers or those with limited savings. However, FHA loans come with mortgage insurance premiums, MIP, that you'll pay for the life of the loan unless you refinance. These premiums protect the lender but increase your monthly costs. Conventional loans. These loans are not insured by a government agency, so they typically require higher credit scores and may demand a larger down payment, though you can put down as little as 3% with certain programs. On the plus side, if you put down at least 20% or eventually reach 20% in equity, you can often eliminate private mortgage insurance, PMI, reducing your monthly expenses. Conventional loans are a good fit for buyers with strong credit, stable income, and a decent amount of savings. Choosing between FHA and conventional often comes down to your financial profile, how much you've saved, and how soon you want to remove extra insurance payments. A good mortgage lender or broker can help you run the numbers and see which option is more advantageous. While FHA and conventional loans are common, there are other options as well. VA loans for eligible veterans, active duty military personnel, and some surviving spouses. VA loans offer no down payment, no ongoing mortgage insurance, and competitive rates. This is often one of the best deals out there if you qualify. USDA loans. Designed for rural and certain suburban areas, USDA loans offer zero down options and competitive rates. They also come with income limits and certain geographic requirements. Jumbo loans. If you're looking at a property that's priced above the conforming loan limits set by Fannie Mae and Freddie Mac, you may need a jumbo loan. Jumbo loans can have stricter credit and down payment requirements since they involve borrowing more money than a standard loan. Adjustable rate mortgages, ARMs. While most people prefer fixed rate mortgage for predictability, ARMs, ARM, start with a lower interest rate for a set period before adjusting periodically. If you plan to sell before the initial fixed period is over, an ARM might save you money, but you risk higher rates if you stay in the home longer than expected. Understanding these options helps you pick a mortgage that aligns with your personal goals, risk tolerance, and how long you plan to stay in the home. As you consider different loans, think about how much you'll put down. While some loans allow very low or even zero down payments, putting more money down can lower your monthly payments and may help you secure better interest rates. Closing costs are another factor to consider. These typically range from 2% to 5% of the home's purchase price and cover everything from appraisal fees and title insurance to attorney fees and lender charges. Some programs allow sellers to cover a portion of your closing costs, or you can negotiate them as part of the offer. Understanding your total cash requirements ahead of time ensures you're not caught off guard on closing day. Before you seriously start shopping for homes, you'll likely come across terms like pre-approval and pre-qualification. While they sound familiar, they aren't the same. Pre-qualification, a rough estimate of what you might be able to borrow based on self-reported financial information. It's a quick and not as in-depth. Think of it as a starting point. Pre-approval, a more formal process where the lender verifies your financial documents, bank statements, W-2s, pay stubs, and runs a credit check. A pre-approval carries more weight when making an offer because it shows sellers you're serious and have the financial backing to purchase. Having a pre-approval in hand can be a deciding factor in a competitive market where sellers want certainty. Shopping around for a lender. Just as you would shop around for the best price on a car or a computer, you should shop around for a lender. Different financial institutions have different loan products, fee structures, and underwriting guidelines. While one might offer a slightly lower interest rate, another might provide more flexible credit requirements or lower closing costs. Request loan estimates from multiple lenders and compare the APR, which includes both the interest rate and certain fees to give you a more complete picture of the loan's cost. Also, pay attention to customer service. A responsive lender who communicates clearly can make the financing process far less stressful. Don't worry that multiple inquiries will hurt your credit score. Mortgage inquiries made within a certain time frame, usually 45 days, are generally treated as one inquiry by credit scoring models. So, if you don't want to significantly impact your credit score, if you shop several lenders at the same time. Credit score considerations. Your credit score plays a big role in determining the interest rate you get and which loan programs you qualify for. Generally, a score of 720 or above is considered excellent and may qualify you for the best rates. That doesn't mean you can't buy with a lower score. FHA loans, for example, allow for scores as low as 580, but it might mean paying a slightly higher interest rate or mortgage insurance premiums. If your score is lower than you'd like, focus on improving it before you apply for a mortgage. Pay down a high-interest credit card balances, make every payment on time, and avoid opening new credit lines. Even a slight boost in your credit score can lead to better financing terms, saving you thousands over the life of your mortgage. Understanding loan terms and amortization. When you settle on a mortgage, you'll likely choose between a 15-year or 30-year term. A 30-year mortgage is most common because it spreads out the payments resulting in lower monthly costs. However, you pay more interest over time. A 15-year mortgage has higher monthly payments but less interest paid overall, allowing you to build equity faster. Think carefully about your long-term plans. If you see yourself staying in the home for decades and want to pay it off sooner, a 15-year loan might be appealing. If you need more monthly budget flexibility, a 30-year loan offers breathing room. You can also consider making extra principal payments on a 30-year loan to pay it off early if your financial situation improves down the road. Considering rate locks. Mortgage rates can fluctuate daily, and if you're under contract to buy a home, you'll eventually need to lock in your interest rate for a certain period, often 30 to 60 days. This protects you from rate increases before closing. Locking in a rate too early might mean you pay extra if it expires before you close. While waiting too long could expose you to rising rates, work closely with your lender or real estate agent to choose the right moment to lock in, especially if you're buying in a volatile rate environment. You might also wonder whether to work with a mortgage broker or go directly to a bank or credit union. A mortgage broker acts as an intermediary, shopping multiple lenders to find you the best deal. They can save you time by comparing several options at once. However, brokers might charge fees for their services. If you have a long-standing relationship with a local bank or credit union, it may provide a more personalized experience and potentially favorable terms due to your established history. The key is to explore both routes and see which yields the best combination of rates, fees, and customer service. Once you've secured your loan and closed on your home, continue to manage your mortgage responsibly. Set up automatic payments to ensure you never miss due dates. Keep an eye on interest rate trends. If rates drop significantly, consider refinancing to lower your monthly payment or shorten your loan term. Your home is a major investment, and staying proactive with your mortgage can save you money over the long term. Navigating the world of mortgages and finding financing can seem intimidating at first, but understanding the basics helps you approach it with confidence. By knowing how to determine affordability, using mortgage calculators, shopping around for competitive rates, and exploring different loan options, FHA, conventional, VA, USDA, and more, you'll be on your way to making an informed decision that supports your long-term financial goals. Remember that this is your journey. Don't rush the process. Don't hesitate to seek professional guidance if you're unsure. Financial advisors, mortgage brokers, and real estate agents are there to help clarify terms, break down options, and provide personalized advice. If you found this video helpful, please hit the like button, subscribe for more real estate insights, and feel free to share your thoughts or questions in the comments below. Your home buying experience should be exciting, not overwhelming, and understanding your financing options is a big step towards making that a reality. Thanks for watching, and best of luck as you move forward in your home ownership journey.